Coming up today, S&P posts its third straight losing day after a record options expiry, rising tensions in the Middle East, Circle stock goes ballistic, possible dissent at the Fed, robo-taxi set to launch this weekend, and the number one warning signal for stocks that you need to be aware of. It's going to be a good one, guys. Let's go. And welcome back, everybody. After yesterday's public holiday in the markets, we've finished the shortened trading week on a bit of a mixed note here. And just looking at the heat map, it doesn't look like it, but the S&P 500 and the other main indices actually finished lower today. But just looking underneath the hood, there was a bit of a defensive feel and rotation with some staple stocks actually catching a bid there after being sold off the last couple of weeks, along with a bit of a bounce back in the defense contractors and energy, oil and gas stocks still trading firmly on the back of crude oil, currently sitting at multi-month highs. And we actually saw a bit of a pullback in mega cap tech today, bar Apple, which has also been a bit soft of late. And we finished the week with the fear and greed index right on the cusp of the greed zone. Market kind of in a middle ground here, maybe a bit of a fork in the road, leaning a little bullish in sentiment and positioning. We've seen that in a number of indices, like the active investment managers exposure index, now getting towards the high end of its typical trading range. And this is usually when we can see pullbacks in the market or short-term tops whenever this index goes above 90, around 95, 100. And so we just had the last monthly options expiry for Q2, for which it was a record, almost 6 trillion. And just as this data shows here, over half of that is just in SPX options, index options, a huge market. And about $1 trillion worth of options expired today just in single stock. And just looking at previous monthly options expiries we've had this year, they often coincide with some turning points in the market, especially there in March and February. And we have been coiling up quite a lot. Coming into this OPEX, didn't really uncoil there today, with the VIX still hovering just around 20, as we're still deep into a volatility contraction cycle, as we can see here in my volatility heat map indicator. It's been dark for a couple of months now. And we do have some signs of waning breadth, with the percentage of stocks above their 200-day average, still below 50% at 45 here, and the official S&P 500 index closing below that psychological level of 6,000 today. And just looking at my sector trends table indicator, is somewhat of a bearish setup. S&P's lost its 20-day MA, along with yields turning down, volatility turning up, along with oil and energy, discretionary coming off somewhat. Bitcoin as well today, just lost its 50-day VWAP, and we've got inflation expectations trending up and a bit of global equity market bearish breadth out there as well. And there's a look at the risk-on proxy, Bitcoin losing its 50-day VWAP today. Is this the canary in the risk-on gold mine, giving us a little heads up? We're going to take a look at that and a lot more today. Stick with me because I'm going to show you the bet I made on prediction markets about what I think the Fed is going to do next, along with my reasoning for it, and also share with you some options trades as well. And an update on what's going on with Iran, what I think may be about to happen, and what that could mean for crude oil, along with some of the hottest stocks in the market, including Circle, on an absolute heater here today. But first, what I think the number one warning signal for stocks could be is what the bond market's been telling us for a little while now, specifically looking at the yield curve between 2-year and 30-year treasuries, and given that about a 2-year lead because the bond market is more sophisticated, better at pricing the future, and often early too, before stocks. And there's been a remarkable correlation the last couple of years between the S&P 500 and the 2-year and 30-year spread, suggesting stocks could be about to head lower or potentially vulnerable to do so if this correlation were to hold true. And we've got a bunch of other interesting charts out from i3 Invest today, also suggesting that stocks are vulnerable for a bit of a fall here, which is not that unusual for year 3 of a bull market. And after the significant recovery we've had, just looking at the relationship between bond market volatility and equity market volatility, with the 1-year lead time also suggesting stocks could be vulnerable for a pullback. And the US Coincident Economic Activity Index combines wages, employment, income, spending, also showing a sharp divergence with the S&P 500. And the Dow Transports as well, not confirming current highs in the market, something we also saw back late in the dot-com bubble. And I'm not suggesting the secular bull market is over just yet, but this data does give reason for pause and could potentially be a good time to add hedges on, given we are near highs and volatility is relatively low, with no shortage of risks right here on our doorstep. Or could it be a case of the economy really splitting into two, and what's been kind of a long-term K-shaped trend, the rich getting richer and the middle class getting poorer? Because there's quite the gap. The top 10% richest Americans account for half of all consumer spending. The bottom 60%, not even 20%. And it's the wealthy that's really holding up consumer spending, even though many consumers are struggling with the cost of living. And right now, the stock market has more of a correlation with this black line than this yellow line here. But for how long can this divergence go on for? And if and when the wealthy do pull back their spending, maybe that's when we see a big and sharp correction in the market. But it's kind of a self-fulfilling prophecy because That's what often causes the wealthy to pull back their spending, is a pullback in the market property as well. But counteracting these soft macro indicators of late is the fact we do have a lot of hot momentum in this market, especially in retail favorites. And trust me, you shouldn't underestimate retail traders with what we've seen the past couple of years, for which there is a number of cult stocks that retailers really got behind and driven big gain. Nonetheless, being Palantir, a retail favorite for a couple of years now. It's been an absolute smoke show. And others as well. Hims and Hers Health, Carvana, Rocket Lab, Quantum Stock's been on absolute fire, and newcomers like Oscar, Tempest AI, and other AI related names like Nebia, all performing very strongly this year. And the hottest stock today, recently launched onto the market, Circle Internet Group, the company behind USD coin, stablecoin. No doubt getting traders excited, strong political support, with the US looking to lead on digital assets. And that's on the back of the Senate passing the landmark stablecoin bill, allowing for this stuff to go legit, officially be regulated, and companies now getting the green light to use this stuff, which has also helped Coinbase, the largest crypto exchange in America, and they actually receive half of the revenue generated from the interest earned on Circle's USDC reserve, also keeping 100% of the interest from their own USD coin reserve. And like I said, even though Bitcoin is a little soft here, Circle's been on an absolute momentum blast off, up 20% today, still rallying after hours as I speak. It's only been on the market for a couple of weeks and has already more than tripled from where it first started trading. We've seen a good rip in Coinbase this week as well. Big volumes coming in here. Looks like institutional money to me. No doubt this is going to be a staple and go-to name for institutions wanting big US dominated crypto exposure now with strong political support. But I do think Circle could be getting a little ahead of its skis here. Market cap hasn't updated for today, now above 50 billion, now on par with a similar valuation to FedEx, has been around for 50 years. And with Coinbase and Circle pretty much joined at the hip, I think that's going to prove for them to have a material and technical relationship going forward. Hence on my watch list for a potential pairs trade next week is long Coinbase, short Circle, using options of course, because I wouldn't short a stock like Circle outright just with common shares, but with options that allows us to set up a risk-defined trade. And so I'll be sharing that with my options members in the chat room if and when I put that trade on next week. And if you're interested in jumping on board that, click the link below this video, as I've also got a coupon code there to save 30% as well. And stick with me because I'll show you a profitable options trade I actually closed today and shared with members a bit later on in this video. But just getting back to the market for a minute, we're quite complacent here. Realized volatility is still low. We haven't seen an uncoiling, and with that huge recovery and sentiment we've seen this last 2 months, we're now getting a bit of a rhetoric that no matter the macro, no matter the headline, it can all be shaken off, because quite often these geopolitical events are buy the dip opportunities, but not always, especially if they're on a large scale. And what's going on with Israel and Iran, we've never seen it at this level before. This is a pretty big deal in my opinion. But Wall Street has come back a big way, upgraded their year-end price targets on the S&P 500, chasing and herding like they normally do. And so as usual, we've got quite a few things going on. Softness in macro indicators, geopolitical risks, lofty valuations, but still a lot of momentum in growth names, plenty of participation in the market. Which one is it? Are we in a bull market, bear market? Or like I've been saying for a little while, may actually be a kangaroo market. We're bouncing up and down. Not even the Fed knows what to do. Jay Powell umming and ahhing over where and when he's going to move next, as he's been pushing the wait and see narrative for a few months now. But one of the Fed's governors today, Christopher Waller, who could be a potential favorite candidate to replace Jay Powell next year, and certainly putting himself out front today with his rhetoric, suggesting he thinks the Fed should look through one-time price increases from tariffs, and they actually should cut next month, suggesting the data supports a cut and that they shouldn't wait for the jobs market to fall apart before cutting. Acknowledging what's going on with the Middle East and oil has to be seen through first, but he's not wrong about the jobs market, with claims and unemployment curling upwards, coming off lows that we've been at for a couple of years. And actually, by some measures, we've already crossed the threshold for a recession around the corner, just looking at the jump in jobless claims as a percentage increase from cycle lows. We're quite a bit above a threshold where every other time that has happened, we've got a recession here in the grey. But of course, recessions are much more rare in modern day markets. And that likely has something to do with the Fed being able to print at will, like in 2020. They backstopped the market and economy in tandem with the government. Pretty smart, to the point that actually overflooded the system, causing inflation, which has significantly inflated asset values and thus widened the gap between the rich and the working poor. So is this time truly different? Because we're kind of back to a spot similar to 2023. We had a lot of indicators suggesting a recession could be imminent, along with the bond yield curve. Maybe that's a little different nowadays as well because of the events from 2020, along with the front end of the Treasury's debt maturity profile being loaded up a lot, pressing short-term rates. No surprise to see the president not happy about all this. Too Late Powell is his nickname for the Fed chair. Coming out with strong wording once again after he's saying he's already tried to be nice, he's tried to be neutral, and now he's been nasty. For which he acknowledges it will be hard for Jay Powell to cut rates given his rhetoric. And in my opinion, I think Jay Powell's pretty much signaled to the president, you cut tariffs and I'll cut rates, as Jay's constantly pointing to the potential risks to inflation because of tariff. Not that we're really seen it show up yet anyway. And we've actually seen some sharp criticism from Bill Pulte, the grandson of the Pulte Group home builder company, $20 billion stock. He's now the US Director of Federal Housing, coming out saying Jay Powell is the main reason for the housing supply crisis. By improperly keeping interest rates high, Powell is trapping homeowners in low-rate mortgages and choking off existing home sales, directly fueling the housing supply crisis. He must lower rates. Also calling for him to resign. Pretty strong words. And so just looking at Polymarket, which is a prediction market that operates just like a stock exchange. You're not playing against the house, but rather other players. Pricing in an 87% chance the Fed stays on hold in July, which is largely in line with where Fed fund futures are pricing as well. And I don't think the Fed, barring any surprise between now and July 30, will cut next month, but the pressure is building on Jay Powell. We see this Iran situation resolved, oil can pull back, all the other data supports Jay Powell cutting rates. If not, he should have already. And that's why today I placed a further bet on the Fed cutting rates in September here on Polymarket. Given the odds are quite a bit lower than what Fed fund futures are pricing, I've actually got 707 shares paying an average 42 cents for each. And I'll look to scale into this bet. If I still think there's a good chance the Fed will cut in September, which I do, and if Fed fund futures are still pricing in greater odds, there's quite a discrepancy there between Polymarket and Fed fund futures. Pricing in 60% odds, we get a 25 basis point cut in September versus the 42% that I pay. And so it is possible, and we've seen an increase, especially after Christopher Waller's statement today, that they could cut next month. I would say oil would have to come down, maybe some more weakness in the macro, a soft CPI, soft labor market data, then that could happen. And if so, I would say it makes it even more likely we get another cut in September, because typically when the Fed cuts, they cut multiple times in a row. Normally at least 3-4 meetings, if not a few more, before they kind of find their resting rate and wait and see. And if they don't cut in September, that likely means the economy and markets are holding up. If not, there's inflation, for which commodities should be doing well. And so this kind of acts somewhat as a little hedge on my long-only portfolios that I can continue to scale in towards. Because if the Fed has to cut, the market's very well maybe pulling back. If not, they should be holding up, or there's inflation, and I've got exposure to commodities as well. And speaking of which, just moving on to something that has a big impact on inflation, current events in the Middle East. And I still think we're on the cusp of a US military campaign directly in Iran. Even though the US president just set a 2-week deadline for strikes to happen, doesn't mean it's going to happen in 2 weeks. Could happen in 2 hours from now. I think if it's going to happen, it's going to happen this weekend while markets are shut. If not, next weekend at the latest. Because in my opinion, it's now or never with Iran. Even if they do agree to stop work towards making a nuclear weapon, like they have done many times in the past, I don't think they will really, especially now, after Israel's just taken out 30 of their top commanders. And now with their defenses down and nobody coming to their rescue, I think it's time to finish the job that's already been started, as we're also hearing reports from the president that he won't push for a ceasefire. Israel's already gone to town on trying to take out as much of their nuclear infrastructure as possible, but they need the states to finish the job with some advanced weapons, potentially even dropping a tactical nuke on their Fordo facility buried deep in the mountains, and stop them once and for all. And I think that's why we've been getting the messaging that we've been getting, preparing us all for what could very well be likely about to happen, because they're kind of already halfway through the job, and we've seen the United States military mobilize a large number of key military assets into the region, being at the very minimum posturing to have a strong hand at the negotiations table. If not, I think actual preparations for a military campaign, given the amount of aircraft now positioned to execute the campaign and, like I said, finish the job. And this can't keep going on for too much longer, because Iran's firing off everything they've got into Israel, and Israel's running out of defense weapons to help shoot all these missiles down. So this is something that's been pending for decades now, Iran's threat. And like I said, now's the best opportunity, and it's now or never. And so obviously this is not what the US president wanted. However, in my opinion, he's always wanted to cut down Iran to size. This is the situation he's found himself in, and after it's all said and done, it may actually be a de-risking event for the Middle East, because this is not just Israel and the States that wants this done. It's also a lot of other neighboring Arab countries, the Saudis, not being the least. And it was interesting to hear from the Russian president yesterday, and his opinion, if Trump had been president, the war with Ukraine would never have happened. And so whilst that's happening, if the Iranians see themselves going down, they may do something in the Strait of Hormuz. Over 30% of the world's seaborne oil goes through there every day. And you can just see in this visualization here how busy a shipping lane it is and how tight it is. That's Iran right here. And so they could block this, which would materially upset the global oil market, which is quite sensitive to this stuff. And just looking at the chart here of crude oil, this to me looks like it could be primed for another uncoiling even bigger, looking at this volume and how quickly the dips are getting bought. And so for sure, it is possible this could spike if the Strait of Hormuz gets shut down. Even if it is just for a day or two, we could spike up to $85, $95 a barrel before the US Navy gets in there and cleans things up. Same look on the United States Oil Fund ETF, USO, potentially shaping up here for one last blow-off, along with the blow-off top in this situation with Iran. We could be on the cusp of that. And just moving on to Tesla, they're scheduled to launch their new robo-taxi service this Sunday after pushing it back from the initial date of June the 12th. Set to go live this Sunday with human monitoring for safety, rolling out in Austin. Already got Google's Waymo, doing over 250,000 automated rides per week. And so this could impact the stock come Monday morning, depending on how the launch goes or doesn't go. We've got the stock coiling up going into this event, and a similar look to the market, just sitting here in mid-ground around the 50-day VWAP, kind of waiting for something to happen. On the other hand, not doing so well today, Alphabet Google, apparently falling after Turkish authorities launching a probe into Google ad tool. Really? Turkish regulators? Once again, I think the market is unfairly punishing Alphabet Google here today, just like it did back on the 7th of May when we got news that Apple may be looking at doing their own search engine. And for which I told you guys back on the daily market review on that day, I think it was overdone, and why I'd been adding to my long-term position in the stock, for which I'd be keen to do again if it kept on dipping down into the 150s. I think is a great buy zone for long-term patient investors. I don't think search is going away. They've always got issues with regulators. That's just part of their business. And their other assets like Waymo, YouTube, Chrome, Android are pretty much being priced like a boring utility. Whereas this company is going to be one of the big players and already is in AI, not to mention robotics and robotaxis. And it may come as a surprise to many people to learn that Alphabet is actually the most profitable company in the world. Currently the only mega cap tech with net income above $100 billion, and that is more than Microsoft and Apple. And so whatever adjustments they need to make, this cash flow gives them plenty of finance and ability to do that. And those network effects with pretty much all of us having a Google account just makes it so easy to enter and dominate new markets. And just getting back into the charts, looking at my themes watch list, which is 180 of the hottest stocks in the market. You can add this watch list to your TradingView platform for free. Just click the link below this video and you'll get this watch list added to your charts today as well. Once again, a little bit of a mixed trading, looking at some of these hot categories here. Bit of mixed breadth out there. Did see a good move up in Rocket Lab there today, along with Black Sky shaping up pretty nicely here. There's a look at the big dog Nvidia, still coiling up just below highs, similar to the market. Quantum still having a bit of a breather, and like I said on Wednesday, pay attention to Oscar Health, the new retail favorite. Smashing up there again today, 13%, monster volume, 70 million shares. Retail is well and alive, whilst other growth leaders like Palantir also just taking a little pause at highs here. And of course, Circle was the big one today, but not too far behind it. Also been on an absolute heater. CoreWeave, AI company that's actually got backing by Nvidia, continues its move up today and actually placed a trade in CoreWeave options on Monday that I shared with my members in real time in our chat room, along with a chart, my reasons for getting into the trade, and a screenshot straight from my brokerage platform of the trade I entered, putting on a bull call spread, which involves buying a call option and selling another one at a higher strike. It's a risk-defined trade, and I actually closed that today for a $500 profit that I also shared with members in real time, along with a screenshot of the fill that I got. And so if you'd like to get my options trades in real time, every trading day I trade the last hour of the US session, sharing my trades in the trade room, along with reasoning and justifications, then now's the time to jump on board because there's only 1 week left to use the coupon code JUN30 and lock in a permanent 30% discount to all of my premium trading services, including the Market Makers Kit, where I share my options trades. And I won't be offering a 30% discount again anytime soon. So if you've been thinking of joining and becoming a member, now's the time to take action. Click the link below this video, visit my site clickcapital.io and become a paid member today, getting access to my trades, all my custom trading tools with full support from me as part of an active trading group. I promise you won't find this stuff anywhere else, but right here with Click Capital, your trusted partner and guide in financial markets moving forward. And just a few more things before I wrap it up here for the week. Interesting look at electricity generation in the United States and the trends over the last 25 years. Significant decrease in the use of coal, gas as well, with a big increase, especially over the last 10 years, in solar and wind. And we've actually seen nuclear somewhat come off, especially the last 30, 40 years as a percentage, but I think we're really going to see that one increase going forward. And I think the market's already starting to price that in with the huge moves we've seen in uranium and nuclear-related stocks, especially this last couple of months on moves from the White House to loosen up regulations and get behind this sector. Artificial intelligence uses an extraordinary amount of compute power, and uranium, pound for pound, is the most efficient energy source, bar none. Very clean as well. And speaking of AI, just to wrap up on something a bit more lighthearted, we've seen a huge advancement in video generation. This has come so far just in the last year or two. What you're looking at here is AI-generated videos, some cats diving at the Olympics. And so it's getting harder and harder to distinguish between AI and reality, looking at this stuff here. Here's another one, 100% AI generated. This one as well, a skier going down the hill. It's already hard to tell what is real and what is not now. And this has big material changes on a lot of industries and jobs out there. And I believe it's just the beginning. And the genie's kind of out of the bottle. I don't think anything's going to stop AI now. Finally, just looking at the VIX, pretty flat on the week after that jump up last Friday. Still holding just above 20 here. Term structure still in contango, but pretty close to getting to backwardation, pretty close for the market to get nervous. And once again, we've seen a divergence in the VVIX index going up today with the VIX spot coming down, meaning the price of VIX index options, the volatility of volatility, is firming up here. But of course, the big one is if and when we're going to see the US finish the job in Iran. Like I said, I believe we're being prepared for that. They've certainly got the military hardware ready to do that. Can't rule out a last-minute deal. That's still possible, but I believe that's just kicking the can down the road to what's inevitable anyway. Now's the opportunity the alliance has been looking for 20 plus years. What will that do to crude oil? It depends if we see a material disruption to the supply or not. The Strait of Hormuz being key. That gets shut down even for a day, we're likely to spike up hard on crude, and I don't see how that couldn't impact stocks, especially coming from this spot of complacency. We've been in some time now. I've positioned my options portfolio to profit if that happens. If not, I've also got bets that can benefit if we continue to melt up. As always, keep a balanced portfolio. And so if you want to be a part of that and join me for trading in the last hour of every US trading session, then click the link below this video, visit clickcapital.io and use code JUN30 to sign up to the Market Makers Kit today and get access to my chat room and all my custom trading tools. That's all for today. Thanks for sticking with Click Capital. Have a great weekend, and I'll see you back here again come Monday night. Cheers.